Good morning and welcome to this special sneak preview of our Model ETF portfolio. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I hope you enjoyed today's special session. So what I want to do today is talk a little bit about the event that we're having tonight and to give you a little bit of a sneak preview of what we go through to determine the various ETFs that will be in our Model ETF portfolio for the next 90 days. First, I'm just going to start off and talk a little bit about, I'll just hang on one sec. So if you're over at earningsbeats.com, we do track our portfolios. And if you go to scroll down, of course, you can always sign up for our Earnings Beats Digest newsletter. But if you click on the historical performance over here, it gives not only our individual stock portfolio performance, but also our ETF portfolio performance. And coming into today, you can see that this quarter, our Model ETF portfolio was up over the S&P 500. That's really our goal each month. Now, whether or not, or excuse me, each quarter, but whether or not we can achieve it is, to be seen every month or every quarter. But I like to, go through the things that I think are important in terms of trying to construct an ETF portfolio. And I always say the most important thing about ETFs is knowing what you own. It's easy just to say, oh, well, this ETF is hot, this one's not, so therefore I'll go with the hot one. But rotation will change things, number one. Number two, you might have an ETF that's performing well because it's in a particular sector, but it still may not own the stocks that are leading that sector. It may be getting lifted because the sector itself is going up, but you don't know for sure what stocks, unless you do a lot of research, you don't know which stocks you own. So I think you got to be really careful when you go into putting together a portfolio. And we've had success in beating the S&P 500. We had one particularly bad quarter where I think the inflation numbers started to take off. So growth got hit and we were in growth that particular quarter. And I think we underperformed by about 9 percentage points in one quarter. But since inception, we're down 3 percentage points. So with the exception of that one quarter, we're actually doing really well relative to the S&P 500. We've beaten the S&P 500 more often than not. And unless things change drastically over the next 48 hours, we're likely to outperform again. So what I want to do is talk about what we do to go through and develop this Model ETF. All right, so let me start off first by the scan that we run. Now, this is the strong ETF chart list that we put together prior to last quarter's Model ETF portfolio draft. And what we do is we go through, we take a look at all ETFs, and essentially we look to see if the Scooter score, which is the stock chart's technical rank, if the Scooter score is over a certain level. Normally I use about 80 on the Scooter, 75, 80, something like that. And all that does really, the stock chart's technical rank is ranks all the various ETFs on how they've performed over the last 5 to 6 months. So they're not long-term projections, or they're not long-term analyses. They're just looking to see what these various ETFs have done over the past 5 to 6 months and then ranks them in relative strength order. Now, if you've had a really hot sector for the last few months, say like aerospace or defense, these are the aerospace and defense group has done really well. And as a result, if you look at high ranked scooters, you'll see that those areas are doing really well. Another area currently that's been doing really well, an asset class actually, is international stocks, which have been outperforming the S&P 500. So in the current scan that I ran, a ton of international ETFs would have come up, except we don't really, that's not our expertise at Earnings Beats. I'm not really interested in looking at international ETFs. So if you like international, you want to go into international, you have to kind of do your own research there and figure out, where you want to be and that sort of thing. We focus on US based ETFs, and we're going to look at those for the most part that have performed the best. Okay. So here was a list. This was 48 ETFs from the scan that was run last quarter. 48. And I mean, you could go through and you could kind of scan, but you'll see a wide variety of different ETFs. You'll see down here, there's biotech. So IBB. You're going to see some dividend performers that were strong heading into that last quarter. Here's small cap. You got healthcare, you got energy, oil and gas. I mean, we go down the list. Banks, insurance, a lot of different areas. There's your aerospace and defense. There's mid caps. And then the other thing I always do is I always add in the 11 sector ETFs that we like to follow. XLB, XLC, XLE, XLF, and so forth, all the way down to XLY, consumer discretionary. Those are always going to be in our strong ETF chart list, just because it gives us the option. If I like something in consumer staples and there aren't a lot of ETFs in that space, then it's an easy pull for me in terms of putting it into our model ETF portfolio and just focusing on the XLP. All right, so that's step one. Step one is just putting together the strongest ETFs along with the 11 sector ETFs. And from that chart list, I will select our model ETF portfolio. And it's usually made up anywhere from about 6 to 10 ETFs. And I've heard someone in the past say, well, 6 ETFs isn't enough. You're not diversified enough. Well, it depends which ETFs you own. There are some very, very widely diversified ETFs. I mean, even the S&P 500, the SPDR, or anything that tracks the SPDR, that's 500 multinational companies. It's very diversified. So that's step one, is going through, putting together this chart list of the best performing ETFs along with the 11 sector ETFs and getting us prepared to make the selection. Now, the next part of this is really where all the work is done, and that is in the themes. At least today, the work. I'm going to go over an ETF analyzer with you. It's a spreadsheet that we put together. I mean, if you talk about the time that goes into it, the time really goes into the ETF analyzer spreadsheet, which I'll show in a little bit. But the day of the selection, what I really want to do is go through and look at all the themes in the market and just try to figure out, what do I think the market's going to do? Number one, what areas of the market do I think are going to lead? Number two, and then once I've have all that and I decide, okay, this is what I'm looking for, then I'll dive into the individual ETFs and figure out, based on their holdings, based on their allocation to the various sectors, how much I want to put in each ETF. And then I'll show you on the ETF analyzer how we can then come up with some pretty good conclusions at the end of whether or not we've met our target or our goals. So let's move on and talk about some of the themes. And this is a chart I show very, very often. Anytime I'm talking about the market or I'm talking about the themes and what I expect, I believe we're in a secular bull market, long-term bull market. Okay. You can have short-term bear markets, which I called back at the beginning of 2022, cyclical bear market. That's what we were looking for in 2022. I think it's ended. Okay. If you go back and you look at prior secular bull markets, this is back in the 1950s and 1960s, we had 4 separate cyclical bear markets within this long-term bull market. If you look at the 1980s, we broke out into a secular bull market in the 1980 timeframe, and we stayed in it through the 2000. But if you look, well, you'll see that we had some periods of selling, some actual bear markets. 1987 crash, similar to the 2020 pandemic. 1 month, big swoosh down. 35%, and then we started back up again. 1990, we had the Persian Gulf War, a recession, soaring crude oil prices, all kinds of things very similar to what we had in 2022 with the Russia-Ukraine war, rising oil prices, recession, whether you say we've been in one or you think we're going into one, doesn't really matter. It's a slowdown nonetheless, but that was a cyclical bear market back in 1990. 1998, over the summer, was about a 3-month cyclical bear market. All of that was within this long-term bull market, just like the 2018 trade war in the fourth quarter. That's right here. And then 2020, the pandemic, now 2022, a little bit longer cyclical bear market. All of that, in my opinion, is within this longer term uptrend. So I believe 2023, we're moving higher. That's my opinion. I think we could go up 20% or more this year. And if I'm right, that impacts how I want to put ETFs together. Because if the market's going up in a secular bull market, you want to be more aggressive oriented and less defensive oriented. So this is the big picture part of the theme that we go through. All right, how about inflation? I mean, inflation's been a problem since 2020, although I don't think it's as big a problem now as it was. And I think it's going to be less of a problem as we go throughout 2023. Here is the annual rate of core inflation down here. This is how we shot up in 2021. And I think it may have been 2021 when the inflation was really starting to catch fire. That's when our model ETF portfolio had a really bad quarter. I think it was maybe the first, second quarter of 2021, but I could be mistaken. Anyhow, this inflation is starting to roll over and turn back down. Exactly what I suspected we would do in 2022. The Fed has remained tough, talking tough, but I'm seeing the inflation drop. And if we look over here, these are the monthly core readings, just looking at the last 3 years, 3 or 4 years. I guess this is a 4-year chart. And then here's your annual core CPI, again, rolling over. That's the part I just showed you. We went up and now we're starting to roll back over. Right now, we're at 5.69%, which is the lowest we've been in a year. So, I mean, you can talk about inflation taking off, but the chart says something a little bit different as we're starting to roll over. Monthly core CPI, you can see we had the big spike back in 2021, March, April, May, or actually April, May, June, were the 3 big readings. We came back down in 2022 earlier. Back in June, we had a reading that was pretty hot. But if you look at the last 3 readings, we've been down around 0.2 to 0.3, which is 2.4 to 3.6 annualized, the last 3 readings. So if we continue to stay down in this range, or even, mosey up to maybe 0.4 on a month here or there, I mean, if we stay in this range down here, we're going to be replacing some of these higher readings that we've seen. And so this annual rate's just going to continue to drop. So I don't think inflation is going to play the narrative. It's going to have that same narrative in 2023 that it's had the past couple of years. The January effect, or as one member corrected me, the January barometer. Technically, that's what it's called, the January barometer, because January serves as a barometer for the rest of the year. I still like calling it the January effect because I think that January has a tremendous effect on the balance of the year. So when I refer to January effect, you can call it January barometer, vice versa, whatever. What I've done, though, is I've done a history back since 1950 on the S&P 500, and I've looked at all the Januaries, and I put them in order of best performing January to least worst performing January, and I then separate them into quadrants. So over the last 72 Januaries, the top 18 go into quadrant 1, the second 18 go into quadrant 2, third 18 quadrant 3, fourth 18 go into quadrant 4. So the worst Januaries will be in quadrant 4. I can tell you that the worst January in quadrant 1, these are the 18 best Januaries, The worst one went up 4.15%. Right now, the S&P 500 is up just a little less than 4.15%, January of 2023. So if we have anything, any kind of rise from here to the end of January, we will move into this quadrant one. January 2023 will move into quadrant one. And what I can tell you is that the balance of the year, February through December, in quadrant one, moves higher 16 out of the 18 years of the Januaries that were in this quadrant. So that's a pretty strong percentage. Perfect? No. Strong? Yes. The average return of the 18 February through Decembers for this quadrant is rising another 15% over the balance of the year. That 15% does not include January performance. This is strictly from February through December. Tack on 15%. Now that's average, but just tack on 15%. Let's say we finish at 4,000, right about where we are right now on the S&P. If we finish at 4,000, 15% would be another 600. That would take us to 4,600. That would be the average. I think coming out of a cyclical bear market, I think we'll probably do better than the average. I've put a target on the S&P for this year, 4,700, but I wouldn't be surprised if I'm lowballing it. I think we could move to an all-time high later this year. But anyway, that's something to keep in mind, the January effect, because we're halfway through January and it's been a really good month. Look at this, was 2022. Look at 2023. January moving up. If it continues, I think the odds based on history are greater. I think January does a pretty good job of predicting the rest of the year. Look at the balance of the year, February through December, all the other quadrants. Second quadrant drops to 10%. Third and fourth quadrant, if you have rough Januaries, typically you don't have very good years. That was the case in 2022. Look what happened the rest of the year. So watch, in a couple of weeks, we'll know. We'll have what happened in the month of January. I think that's important. All right. Equity only put call ratio. Going into 2022, we needed to reset sentiment. This is an extremely low reading, meaning that there were so many bulls at the end of 2021. The market had nowhere to go. Everybody that was bullish was already in. And this started turning back up. And when this turns up, as you'll see at all these previous points, when we turn up, that's all these red areas. Look over the next year or two at what happens to the stock market. It doesn't do very well. There's a minus 50% back in the 2007 to 2009 bear market. Right here was, close to break even for 18 months. Right here was close to break even for 2 years as we started moving up in this ratio. This, we kind of got a little choppy in through here. But here you can see with this move, and I talked about that beginning of 2022, but now look at where we are. Now we're up here near these peaks. Now, some of these readings are a little off. I don't want to get into that today, but there's been some issues with the equity only put call ratio over at the cboe.com. So I've adjusted mine, and I'm probably more down like at 0.66 right now, and looking like it's starting to roll over. That's important. And again, I don't want to get into a whole lot of that right now, but it is important. All right. And let me just tell you, when we're going down on this ratio, once we top and we start going down, look at the moves in the market. 20% in a year, 101% in 2 years, 56% in 2 years, 47% in a little over 2 years, 112% in less than 2 years. When this rolls over, history tells us we're going higher, and we're probably going a lot higher. So I wanted sentiment to reset heading into 2022. Well, it has reset. Everybody's bearish now. Perfect. That's what we want. All right. Another theme that we want to look at, this is pretty critical. What's going on with the aggressive sectors? Now, they've been going down, but remember, we've been in a bear market. So as we start 2023, and we're seeing the market move higher, XLK is outperforming. XLY is outperforming. XLC is outperforming. XLF starting to roll over a little bit. XLI starting to roll over a little bit. Financials and industrials. When you get the strong ETF chart list, and I'll be sending that out to members later today, the financials and industrials are all over this list. Why? Because look at the last 5 months. Remember, scooters are based on 5 months worth of data, basically 5 to 6 months. Financials and industrials have been outperforming the S&P 500 by a wide margin over the last 5 months. The other aggressive groups have been going down. So do you think we're going to see a lot of technology and consumer discretionary and communication services in those high scooter ETFs? No. In fact, most of the high scooter ETFs were international ETFs, bond ETFs, defensive ETFs, materials, energy, financials, industrials. Those are the areas that were littering the top of the ETF leaderboard based on scooter scores. But if we're starting to move higher and we're coming out of the bear market, do we want to keep going with what's been working? We know rotation has been fierce over the last couple of years. This is going to play a role in how the portfolio is put together later today. By the way, at 5:30 today, we're having our model ETF portfolio draft. So if you want to attend, you do have to be a member of Earnings Beats. But if you go back over to the homepage at Earnings Beats right here, just start your no-cost trial, and we'll get you going there. All right, so this is the aggressive areas. How about the defensive areas? Well, we've got healthcare, which was doing really well over the last 5 months. So guess what? You're going to see some healthcare in the top scooters for ETFs. But look at what's happened so far this year. Look at staples, which were going up. Look at what's happening this year. Real estate actually had not been such a great performer. It still held up pretty well in January. Utilities, which were starting to strengthen heading into the end of the year, though, have turned back over and rolled over. So you got to ask yourself a question. Is the stock market going up or down? Because the answer to that question is going to have a major impact on whether you want to be in aggressive or defensive groups. Our model ETF portfolio outperformed the S&P 500 in 2022 by about 6 or 7 percentage points. And the reason we did that was we saw the bear market coming and we went into more defensive ETFs throughout most of 2022. And defensive groups, as you can see, the healthcare group outperforming the S&P, staples outperforming, real estate not so much, utilities mostly outperforming. Being in the defensive areas was a good thing in 2022. Is it going to be in 2023? Well, let you be the judge. And then you got energy and materials. Energy continuing to be strong, materials very strong going into the year. Now, the thing with energy and materials, I kind of say that they're neutral sectors because they can lead in bear markets or bull markets. Usually bull markets, you want to be in the aggressive sectors versus defensive. In bear markets, you want to be in defensive versus aggressive. But energy and materials can go up in any kind of market. They can lead the S&P 500. Money will rotate into these groups in various markets. That makes it much more difficult for me anyway to figure out what to do with this, with these groups. Now, energy's been strong for well over the last year and a half. Materials, you can see, look at this strength. And then you go into June, you're like, oh, I better be into materials. Look what happens over the next 2 or 3 months. They would kill you. And then you go down, you're like, well, I want to stay away from materials because they're so poor. And then over the next 3 months, they're absolutely on fire. So these are tough areas, in my opinion, to call from a longer term perspective, even 90 days out. And that's what you have to do when you put this portfolio together. You got to be thinking, how much do I really want to overweight materials and energy, knowing that they can turn on a dime? And a lot of it can be out of our control. It could be, with energy, it could be something geopolitical, Anyway, last thing I'll show you in terms of themes, look at gold. I mean, there are other themes too, by the way. But gold relative to the S&P 500 has been going down. I know gold on an absolute basis is going up right now and breaking out. A lot of folks are really excited about gold. It's really just going sideways relative to the S&P 500. In other words, gold's breaking out, but you'd be doing just as well in the S&P 500. When gold does well, this is what I always say. A lot of folks think, well, it's based on the dollar. It is based on the dollar in terms of absolute performance of gold. When the dollar goes down, gold usually goes up and vice versa. But if you're looking at the relative strength, aren't you most interested in whether gold's going to outperform the S&P 500? I mean, if somebody says gold's going to go up and I buy it and it goes up 10%, the S&P goes up 20%, am I going to be happy? No. I want to use gold as a hedge against a poorly performing S&P 500. When is that? It's when volatility is spiking. I mean, if you go back and look at when volatility spikes in the 90s, look at 2007 to 2009, 18 through 20, and then start looking, here's 18 through 20. Look at the relative strength of gold. Here was 2007 to 2009. Here was the other bear market, 2001 to 2003. You want to be in gold relative to the S&P 500 when the stock market is seeing a lot of turbulence. Throughout the 1980s and 1990s, when we were in a bear market, look at gold. Here was the spike in 87. Here was the spike during the 1990 cyclical bear market. But for the most part, gold underperforms the S&P 500. Doesn't matter what the dollar is doing. It will underperform the S&P when the S&P is strong. Look at, we started this bear market, or excuse me, the secular bull market in 2013. That's when this trend line broke on gold. At that point, once we broke out on the S&P 500, get out of gold, period. So again, do you want to go up or do you want to outperform the S&P 500? I think gold goes higher. I just don't think it's going to outperform the S&P 500. All right, last thing I want to do is I want to go through and talk to you about the ETF analyzer. So this is a spreadsheet that we developed at Earnings Beats. I think it's a really cool spreadsheet. And essentially what we do with this spreadsheet is we go through, remember I showed you all of the ETFs that were in that October 19th chart list? Well, these are all the ETFs that are going to be in the January 19th strong ETF chart list. And I've got them all listed. There are 89 of them. Last quarter, there were 48. I have 89 of them here, starting from 1 down to 89. And they're in alphabetical order on ticker. And what you'll see is the name of the ETF. You'll see their top 10 holdings. So their top 10 holdings make up 23% of this ETF. Now, if you want to know, are you widely diversified or not? This is a great column to quickly look at. If your top 10 holdings make up only 3% of the ETF, that is a widely diversified ETF. Now, it's concentrated in the small cap area, so it's not diversified in terms of asset class, but in terms of the number of stocks, it's crazy diversified. So if you just had one ETF and you put it in here, yeah, you got a lot of companies, but unfortunately, you're only covering one theme or one area of the market, one asset class, small cap stocks. Or you could have something like this, which is 6% top 10 holdings, but this is only small cap value. So now you're narrowing the small cap universe down to value. It may be a great performer, but do you want to have all your eggs riding on small cap value? I don't think that's would be a smart way. I don't think that's diversified. It's diversified in the sense of you got a lot of them, but it's not diversified in the sense that you're not covering all your bases. So the first thing here is the top 10. Now, you look at another one like the MSCI Fidelity MSCI Energy Index, 67% are in the top 10 holdings. you better know what's in the top 10. They may be stocks that are not leaders in energy. You want to make sure if it's a concentrated ETF, you want to make sure you've got leaders. And I'll show you that in just a minute. The other thing that we do is all of these ETFs, we break down how much is going into each sector. And then our audit over here is 100%, making sure that all of these total 100% coming over here. Make sure there's no math errors in there, right? So we go through, and now you can look at an ETF and say, you know what? I want small cap that maybe concentrates in healthcare, or, so you could be looking over in the small cap, some of these small caps, and then coming across healthcare is this column right here. There's 17. I mean, you can quickly go down here and see the ones. There's 25%, but that's mega cap. Here's 22%, but that's value. Maybe you're interested in value and you want to concentrate more on healthcare and financials. Well, there you go. Again, know what you own. Now, there's another tab to this folder, or to this spreadsheet. And this tab is for each one of these ETFs, 1 to 89. We've got the top 10 holdings listed for you. So you can come all the way over here to the top, well, all the way to 89. And the top 10 with each stock and its percentage listed. So for instance, the XLY, 69%, top 10, Amazon's 23, Tesla's 10, Home Depot's 10. If you really like those three stocks right now, then the XLY would be a great ETF to be in, because that's 45%, 44% of the XLY. Now, if you come over to some of these others, let's find another one that's heavily weighted. I'm just looking at these percentages down here. Here's 164%. This is small cap energy. Maybe you like small cap energy. Well, I really hope you like these top 4. Helmerich and Payne. Forget SM. Yeah, I don't remember all these names. Are smaller ETF or smaller energy names. But I would look at those individual charts and make sure they're setting up nicely, because for the next 3 months, you're going to own an ETF that has roughly, 40% invested in 4 companies. So if you put it, 40% into this particular ETF because you think, hey, it's small cap energy, I'm really widely diversified in these energy stocks. Well, 40% of your portfolio is now in PSCE, and 40% of that ETF is in 4 names. So all of a sudden, 16%, 40% of 40% is in these 4 names. These 4 names make up 16% of your entire portfolio. Better make sure you like them. Here's another, this is probably some kind of an industrial, aerospace, defense, based on just looking at the names. Anyway, 55% in the top 10. The top 5 are probably somewhere around 35%. Better check those 5 out. Now, if we get into one that's 4%, top 10 is 4%. Do I really care what MRVL looks like? Not really. It's 0.5% of the entire portfolio or ETF. So all this information can help you make a better decision as to what you want representing yourself in your ETF portfolio. And then once I go through and I look at all that, and I think about themes, and I think about the market, where it's going to go, and I look at the various ETFs, and then I start making up my mind after I look at the various sector ETFs, what I might want. Sometimes what I'll do is I'll go in here and I say, okay, the S&P 500 has 25.76% of its weighting in technology. I might think the market's going to do really well over the next, 3 or 4 months. And as a result, I might say, you know what? I want to overweight. I'd like to come up with my target of being somewhere around 35%. And I might want 13% on consumer discretion. I might want 10% on communication services. Industrials are starting to roll over. I might want more like 5% there. Same with financials, maybe 5%. Healthcare, it's been strong, but maybe we kind of just stick with the 15%. Staples, I don't know, maybe 6%. Real estate, that's not been performing too poorly, maybe 4%. Utilities, not really interested there, 2%. Let me see, going across here, that's 48, 58, 63, 68, 83, 89, 93, 95%. Well, I might want more than that in energy, but just to finish this off, let's say 3% energy and 2% in materials. Now, what you can do with this spreadsheet is you might look across here and say, you know what? I really like this capital group dividend value. 42% of it is in top 10 stocks. I like those stocks. I like, you might say I want some of these industrials or maybe, healthcare. I don't know. This is pretty widely diversified. Let's just say, hey, I'm going to throw 20% in there. And this isn't going to make any sense, but I'm just going to start putting numbers in so you can see where I'm going. So I've put 20%, 20%. I might say, hey, I'm going to give me this 5% on this energy. I'm going to come down here, biotechs. Okay, 5% there. I like biotechs. Infrastructure. Wow, that's a widely diversified infrastructure. Let me take 10% of that one. Home construction likes the early part of the year. I don't know, maybe we'll do another 5% there. Mid-cap 400, just to be somewhat balanced and move into mid-cap area. Maybe we like mid-caps. Let's put another 20% there. So where are we? Let's say, okay, I think I'm done. There's, what's the total? Whoops. It's telling me there's an error. I've only put in 85% so far. So let's just put another 15% in these dividend leaders. Now I have no error and I've got 100%. But did I get the ETFs to achieve what I wanted to achieve? The ones I picked, S&P 500 is 25.76. I just picked ETFs that only give me 8% coverage in technology. Consumer discretionary is good. Industrials, too much industrials, too much financials. Way too much utilities, too much energy. Do you see what I'm doing here? I just picked what I thought would be some, and I just randomly put the numbers in there, but it didn't give me what I wanted. And so I can go in, and this is where a lot of times for me, the XLB all the way down to the XLY, the 11 sector ETFs, this is where if I want to make sure, maybe a lot of the really hot ETFs don't include a lot of technology. There's one. Look at technology and discretionary. A lot of technology and discretionary, 66% worth in this particular ETF. And it's one of the higher scooter scores with these high rankings. That's pretty impressive. So this is one I can tell you I'm going to be very interested in. But there are others. I mean, there's 32% technology. This is the wide moat ETF from the Morningstar wide moat. So, there's 19% that, maybe I want to kind of catch financials. So maybe the Fidelity high dividend is one I might consider. But anyway, I'm going to put the percentages together ultimately with the goal of trying to get these numbers, my results, to come up close to my, what I'm thinking from all the themes. Bottom line is know what you own. We're going to go through this whole process at 5:30 this evening. If you like this, and again, these were just random numbers. This has nothing to do with what we're going to end up doing tonight. But it takes your allocation times all of these sector allocations and puts it up here in your results to basically tell you whether or not you know what you own. If you want to own 35% technology and you put all these allocations together, do you own 35%? Or maybe it's 33%, maybe it's 38%. Maybe you're okay with that. These are just targets, 35, 13, 10, whatever. But if you come up at the end and you only have 5% technology, it's probably not really what you wanted. You need to rethink your strategy. You need to go back and look for other ETFs. Anyhow, that's what I had. I hope you enjoyed this. We like to do this from time to time. This is a quarterly event. I think that this ETF analyzer is the best ETF product out there. I've never seen anything quite like this. This spreadsheet is available to our annual members at Earnings Beats. So if you're an annual member, if you want to become one, this you can download right into your account. Every quarter we'll update it, give you a new one, so that you can go through and decide what you want to do for your portfolios. Maybe you don't like what we're doing. One last thing I'll mention here is at the bottom, let's say you want to add some ETFs to this spreadsheet that for whatever reason don't meet the criteria because maybe the scooter score is too low. Maybe it's an international fund that you want to put in here. Maybe it's, I don't know, an inverse fund. The other thing you'll notice, there's no inverse, there's no leveraged. I don't do any of that stuff with this Model ETF portfolio. But you could come in here and just add a ETF, whatever it is. And I mean, if you're so inclined, you can go get the top 10. You can list it on that other tab. You can put it here. You can break down that ETF that you choose and use the percentage here. The calculation will still go through and calculate based on the ones that you input. Just make sure that when you add them across, that they total 100%. That would be the main thing. And then put your percentage in. If you've got an international ETF that you want to invest 20% in, put your 20% in here. The only thing I'll say about international ETFs, just beware, the dollar plays a role. So a rising dollar will hurt you in a foreign ETF, a falling dollar will help you. There's actually a currency component. All right, that is it for me. I appreciate everybody tuning in. Again, go over to Earnings Beats, sign up for that 30-day trial. We'd love to have you. Hope you enjoyed the session, and I hope to see you later today at 5:30. Have a great day, everybody. Happy trading.